What if I told you that the number on your screen right now isn't the real price? What if the entire mechanism you've been taught to trust for measuring wealth is fundamentally broken? Today, we witnessed something extraordinary, a market event so revealing, so undeniable that it exposed a 40-year deception in real time. Within hours, two contradictory prices for the same commodity emerged simultaneously. One on the screens of Wall Street, one on the streets where actual money changes hands. The difference? $34 per ounce. This isn't a glitch. This is a system collapse broadcasting itself in real time, and almost nobody is paying attention. Let me set the stage. For the past 18 months, we've been tracking an anomaly that nobody talks about in mainstream financial media. Institutional investors, central banks, and industrial manufacturers have been quietly accumulating a resource essential to modern civilization. Solar panels, semiconductors, medical devices, battery technology, all require this one material in unprecedented quantities. Yet the price remained artificially suppressed. The mechanism keeping it suppressed? An intricate web of financial derivatives, leverage, and something called paper contracts that have absolutely nothing to do with physical ownership. Here's where it gets interesting. The commodity exchanges operate on a fractional system. For every ounce of physical material in a vault, there can be 50, sometimes 100 paper contracts claiming rights to that ounce. It's a game that works perfectly fine until something breaks the illusion. And that's exactly what happened this week. Think about your own situation if you're an individual investor. You're told that the financial system is transparent. You're told that prices discover themselves through free market mechanisms. You're told that supply and demand create equilibrium. But what happens when you can't actually get the commodity at the listed price? What happens when the people who make real-world products, the people building actual technology, can't access inventory at those quoted numbers? This is the confusion point for most investors. The disconnect feels impossible. How can the price be $86 on one system and $120 on another? In a logical market, this shouldn't exist for more than microseconds, yet it's now persisting for hours, days. This persistence tells you something critical. The official number is fiction. In the next section, I'm going to show you the forensic evidence. I'm going to walk you through the exact mechanism that created this split. But here's the hint. Follow the government. Follow the places where official policy meets supply chain reality. Because the moment this divergence became visible, something shifted at the highest levels of power. Within hours of this market event, legislative discussions began. Not about stabilizing the financial system, nobody cares about that, but about securing something very specific, access to physical inventory when the official channels close. The government doesn't care what number appears on Bloomberg. The government cares that its defense contractors can source materials. And today, the government realized they can't. Let me walk you through what happened using a new lens. Imagine you're running a major electronics corporation. Let's call it TechCore Industries. You're based in Vietnam. You manufacture components for renewable energy systems. You need silver, not paper contracts promising silver, but actual physical silver, to complete your quarterly orders. For the past 2 years, TechCore has been buying at relatively stable prices through conventional channels. But this week, something changed. Your supply contact tells you the situation has become critical. The paper price crashed. This is true. But here's the contradiction. Your suppliers refuse to sell at that crashed price. Why? Because they understand something fundamental that most retail investors do not. The paper price is maintained through a specific financial tool called delivery suppression. In practical terms, whenever the price moves higher than these financial interests want, they flood the market with paper contracts, not backed by physical inventory. This increases supply on paper while decreasing it in reality. The price drops on the exchange, but it doesn't drop in warehouses. It doesn't drop with actual dealers. TechCore's procurement team faces a choice. Accept delivery from the official exchange at $86. Impossible. There's no actual stock. Or find private dealers willing to sell at $120. They choose the latter. They wire the money. The physical inventory moves. The official price remains disconnected from reality. Here's where the story gets darker. The government warehouses, the strategic reserves supposed to safeguard national industrial capacity, sit largely empty. Not because they were sold off, but because the pricing mechanism that was supposed to manage them collapsed under its own contradiction. When you set the official price artificially low, you're essentially offering a subsidy to anyone willing to move the commodity away. And move it, they do, primarily eastward. Now consider a second scenario. You're a Chinese industrial consortium, and you've been observing this market for years. You watch the Western exchanges with fascination because you understand how they work. You see the pricing disconnect, you see the opportunity. At $86, silver is essentially being handed away, so you buy. Your traders call their counterparties. We'll take everything. Contracts flow east, inventory flows east. The exchanges can't stop it because the fundamental economics of transport and profit overwhelm any regulatory resistance. The banking institutions managing these exchanges face an impossible situation. They've built a financial superstructure based on maintaining a certain price level. That price level depends on keeping the leveraged bets, call options with specific strike prices, from expiring in the money. If the price stays above $90, they lose billions. So they execute a coordinated push through algorithms, through concentrated selling, through the use of leverage that lets them control prices without actually owning the commodity. For a few hours, it works. The price crashes to $86. The options expire worthless. The derivatives settle. The banks survive another month. But something unexpected happens during those hours. The physical market reacts. Here's what the banks didn't anticipate, or perhaps they did but couldn't prevent. When the official price crashes without accompanying physical supply, a secondary market explodes into view. The first evidence appears at government facilities. The sovereign minting operation, the entity responsible for producing the nation's official coinage, issues a notice. They're suspending sales. They claim they need to recalibrate pricing. This is vocabulary that sounds innocent unless you understand what it actually means. Recalibration is a euphemism for we cannot source inventory at the official price. The government tried to purchase blanks from suppliers. Those suppliers demanded much more than the exchange price. The government couldn't justify the markup internally, so they stopped selling. This is a physical default, but it's disguised as administrative process. The second evidence comes from the largest retail precious metals dealer network. They've always operated as a scaling business, small customers, medium customers, large customers. Today, they implement a policy change. Here's where I need your perspective. In the comments section, I want to know, are you still looking at the screen price as the real number? Have you considered that every major institution with actual physical inventory, the government, the dealers, the industrial buyers, is telling you the real price through their actions, not their words? Because that's the key insight here. Actions and words have diverged. The words say $86. The actions say $120. Which are you going to believe? Second question. If this mechanism can suppress the price of this commodity, what else is it suppressing? What other markets are operating with the same contradiction between official price and actual availability? The reason I'm asking is because understanding this event changes how you should structure your entire portfolio. If you can't trust the price discovery mechanism for one commodity, why would you trust it for others? Like this video if this explanation makes sense. Share it if you think people need to understand this before the next wave of volatility hits. And subscribe because the follow-up to this story is where the real surprise emerges. Because here's what's coming next. And this is where the story moves from explaining what happened to predicting what happens next. The government has taken notice. The national security apparatus understands that a broken supply chain for critical materials is a vulnerability. You can't build semiconductors on paper contracts. You can't manufacture solar panels with financial derivatives. When your manufacturing base can't access raw materials, your power position weakens. Within days of this crash, policy discussions began at levels we're not supposed to see. Discussions about price floors, discussions about strategic stockpiling, discussions about the government itself stepping into the market to ensure that critical materials remain accessible to domestic industry. This is the last thing the institutions managing the financial derivatives want. Government price support moves directly against their interests in suppressing the price. So we're entering a new phase, the phase where the financial system's interests and the government's interests are beginning to diverge sharply. The banks win if the price stays low. The government wins if the price rises enough to ensure supply. These two forces are about to collide. And when they do, the game completely changes. In our next deep dive, we're going to break down the exact policy proposals being discussed. We're going to show you how government intervention could force a rapid repricing. And we're going to explain why the window to understand this opportunity is closing rapidly. The screen shows one price. The vaults are empty. The government is paying attention. One of these facts will dominate the next phase of this market. And that phase is probably measured in weeks, not years. What happens when the government's need for supply meets the bank's need for low prices? That's the collision point. That's where fortunes transfer from one group to another. Stay tuned.